Ladies and gentlemen, good day and welcome to the SP Apparels Q3 FY22 earnings conference call hosted by Batlivala & Karani Securities India Private Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Ms. Prerna Jhunjhunwala from Batlivala & Karani Securities India Private Limited. Thank you and over to you, ma'am.
Thank you, Janice. Good afternoon, everyone. On behalf of B&K Securities, I would like to welcome you all to 3Q FY22 post-result conference call of SP Apparels Limited. Today we have with us the senior management including Mr. P. Sundararajan, Chairman and Managing Director of the company, Mrs. S. Lata, Executive Director, Mr. S. Chenduran, Director, Mrs. P.V. Jiva, CEO, and Mr. V. Balaji, CFO. I would now like to hand over the call to the management for initial comments. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and very warm greetings to all of you who are present on the call to discuss about our quarter 3 FY22 results performance. I hope and wish that all of you and your loved ones are healthy and safe. Before discussing on the performance of each division, I would like to apprise you the development of the retail hive, which has been completed on 1st January 2022. We have shifted the operations of retail into our wholly owned subsidiary SP Retail Ventures at a consideration of rupees 53.5 crores. This consideration will be converted into equity at an appropriate time. Further, I would like to take this opportunity to inform all of you that we will be looking to raise PE or strategic investments in our new retail venture to grow the business and excel in its industry. Now let's talk about the garment division segment-wise performances. For garment division, the shipments to customers has increased both in terms of Q-on-Q and year-on-year. In terms of customers, we have added one new customer from US and expected to receive initial orders in the next 4 weeks' time. This addition from US will surely dilute our concentration in the UK geography. I would like to update you on our strategy in increasing the utilization levels by aggressive sourcing and training of workmen, which has started yielding better results now. The process of starting our second shift is still to be commenced and likely to happen in the month of May, and will update you all on this soon. Our current order book stands at rupees 330 crores. Our garment division revenue for this quarter stood at 223.8 crores versus 176 crores for Q3 FY21, which is at a growth of 27% year-on-year. The total revenue for 9 months stood at 523 crores versus 373 crores for 9 months ended FY21, at a growth of 40%. Adjusted EBITDA of the garment division stood at 44 crores for the current quarter as against rupees 38 crores of Q3 21. Adjusted EBITDA of the garment division for 9 months stood at 110 crores versus 75 crores of 9 months FY21. Regarding spinning is fully being utilized and is yielding good margins, adding to the garment division's margin. Our expansion of 3 frames, that is 3,600 spindles, is completed currently and has started yielding production effective on 1st of February this year. Further, as instructed in last call, to mitigate the risk of availability of quality yarn and consistency in supply, we have tied up with the mill on a conversion basis so that supply is uninterrupted without any volatility. Regarding processing, this division's utilization level has increased which means we are working even on 2 Sundays a month. So the working days have increased. Coal prices have started decreasing, and raw material prices and supply chain cost escalations are putting margins at stress level in the processing division. We have worked an alternative mechanism to mitigate the price escalation in coal during last quarter. Regarding SP Apparels UK division, SP UK has seen a lot of disruptions in supply chain, majorly due to the third wave in the UK and Europe. Escalation in the container cost has put the supply chain on a standstill and disturbed the revenue for the current quarter. The position is improving now, and SP UK will pick up its sales from Q1 FY23. Revenue for the quarter stood at GBP 1.4 million as against GBP 2.1 million year on year. Retail division performance has been separately disclosed to the exchange as business of discontinued business in our standalone financial reporting structure. Further, as highlighted in the opening remarks, we will be looking for some PE or strategic investors into our retail ventures to grow the business and move to the next level in our retail operations. The current liquidity position is strong, and we have serviced all the debt up to date. Thank you. Now I will request CFO to give an overview of the financials. Thank you.
Thank you, sir. Good afternoon, everybody. I'll just run through you the financial performance of the company. The revenues for this quarter stood at 254 crores on a consolidated basis, which is 20% more than year on year. Our consolidated EBITDA stood at 41 crores. Adjusted EBITDA stood at 41 crores as against 39 crores year on year. And our PBT stood at 30 crores as against 26 crores year on year. Adjusted PAT stood at 24 crores as against 19 crores year on year, which is an increase of 25%. On a 9-month basis, our revenue stood at 609 crores on a consolidated basis, as against 459 crores year on year, which is an increase of 33%. Adjusted EBITDA stood at 107 crores, as against 78 crores year on year, which is an increase of 37%. PBT stood at 78 crores, as against 43 crores year on year, which is an increase of 18% year on year. PAT stood at 59 crores, as against 32 crores year on year, which is an increase of 82%. On a garment division, the revenue stood at 223 crores for the quarter, as against 176 crores, which is an increase of 27% year on year. Garment margin stood at 19.7%, as against 21.7% year on year. SP UK revenue stood at 17.6 crores as against 21 crores, which is reduction in the revenue due to the reasons explained by the chairman. Our gross debt stood at 130 crores and net debt stood at 105 crores. My working capital limit net is 55 crores and term debt is 50 crores. My inventory as on 31st December is 240 crores. Is mainly because of increase in cotton prices and the yarn prices. Debtors receivable is at 70 crores and payable is at 71 crores. Other information are available in the presentation, and we can get into the question and answer section. Thank you.
So can we open the call for a Q&A session now?
Yeah.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Chirag Lodhia from ValicQuest. Please go ahead.
Yeah, thank you for the opportunity. Sir, this 330 crore order book, if you can help us understand compared to say pre-COVID, how is it looking like? Is it, much above pre-COVID order book levels or it is similar to that? Basically, what I'm trying to understand is how is overall demand trends in, garment division?
In terms of demand, I think there is some good demand which is coming up. When you compare our order book prior to COVID and after COVID, so like our order book prior to COVID was somewhere around 250, 260 crores, and now we are sitting on an order book of 350 crores. And the demand is really very, very strong.
Yeah, let me explain to you. See, the order book has increased. It used to be 260, 270 crores. Now it is 330 crores, which is is against it's a project-based order. So we have a firm delivery of say 3 to 4 months time. So which means 330 crores will be 80 to 90% of this value will be shipped in 3 to 4 months time. So this is always the case, and this itself is a clear example that there has been an increase in demand for the supply from our existing customers, and that's the current scenario. So we are going very strong with the order books now.
Got it. And second on sir, margin, given the inflationary trend, on a QOQ basis also, how are you looking at margins in garment division going ahead? Any range that would be helpful?
See, one of the reasons why there is a small dip in garment division margin is only because suddenly we have booked the orders at the prevailing prices of yarn and the dyes and chemicals. But after the order book, nobody expected during the beginning of the cotton season the prices will go up so much. So this is where it has misled us to some extent. So we could not ask for increase in prices from our customers. That's the reason why there has been a little bit of drop in the margins. But now the customers have started accepting the increase in the cost price, because all over the world, the supply countries, this is the situation. So they have started agreeing to reasonably increase the prices. So we will be back to the same situation of what we used to have the margins.
So is it fair to assume that 20% kind of margins in garment division should sustain going ahead also?
No, we always give you an indication. The guideline is 18 to 20% always. That is how we work towards. If anything comes extra, it's a bonus. So we try to always maintain between 18 to 20. So we don't really give any false promise there will be a big jump or something, because all streamlined. Our costings and the products and customers' requirements all streamlined. So this 18 to 20 is working out all the time, irrespective of any volatility. So we don't commit anything much bigger than this one. If it comes, well and good.
Right. And sir, in retail division, this quarter, there was spike in losses. What was the particular reason, and how we should look at retail division on an annual basis? What kind of cash losses one to expect going ahead?
Retail division for the current year has made losses, and we were not able to make sales during the month of December because of the transition into the new company. So all the stocks were kept on hold until there is a movement into the new company. So retail has made losses for the current 9 months also. And going forward, I guess things when it stabilizes. So like Q3, if you look at the month of October, we had disturbances where we were not able to open shops during the weekends. Saturdays and Sundays were not allowed to open. So we had disturbances in Q3 because of the COVID. But going forward, we guess that there will be good amount of traction in the revenue and move to the next stage. So that is about retail.
Got it. And sir, just lastly on overall debt position, what to expect by next year end? What kind of debt levels will be at?
I think on the debt level, our current debt is close to 105 crores, and on the term debt we have 55 crores, and on the working capital we have 50 crores. In spite of increase in the cotton prices and all the supply chain, we are able to maintain the debt at the low level. In case if the cotton prices have not gone up, we would have come to a stage where we don't have any debt. But debt, I guess, is purely based on how we work on the working capital. But I guess we are working towards a zero debt in 1 or 2 years' time.
Right. Got it. Thank you and all the best. That's it from me.
Yes.
Thank you. The next question is from the line of Kaustubh Pawaskar from Sharekhan. Please go ahead.
Yeah, good afternoon. Thanks for giving me the opportunity. So my first question is on your differentiated mechanism, which you indicated during your initial comments to mitigate the raw material pressure. So can you just explain it? What kind of mechanism or pricing strategy you are alluding towards?
No, you are talking about, I guess it's regarding the raw material yarn, right?
Yeah.
Mitigation. Yeah, we instead of we buy from the open market, currently our existing capacity can manage up to 60% of our requirement. So the balance we have to buy from the open market. So now we have increased the capacity so that the number one, we get the confirmed delivery of yarn and the required quality, because our baby's product, so the quality requirement is very, very, very sensitive. So we have a very consistent quality which we cannot get from the open market. And the third one is at least we have a firm the price without any volatility of the cost price of the yarn. So these things will mitigate our risk in terms of quality, delivery, and the price.
Right. So this 60% has gone up to how much? Like 60% of requirement is through internal
Now about 80 to 90%, or even 80% I would say.
Okay. 80% of requirement is in-house, 20% you are buying from the open market.
Open market, correct.
Right, sir. And so on the pricing strategy, as you mentioned that since the yarn prices and dye prices were booked earlier and it was difficult to increase the price. But now since the market is opening up for the price increases, how what is the maximum level where you can increase the price which will be comfortable for this your customers?
Yeah, it will actually it is working out to 16 to 20%. But we have already asked the customer to increase for 20%, but they say for them it will work out to 14 to 16%. So they are ready to give up to 15% now increase.
Yeah.
So have you taken 15% increase or still it is to be taken?
Yeah, we have already taken 15% increase for the future.
Okay. And my last question is on your capex. So now you have completed, already completed this increase in the spinner capacity. Any further capex you are looking for?
If you look at what we have guided for in the last phone call, we have spoken that we are going aggressively moving towards hostel, and we are investing close to around 20 crores of hostel facility into hostel facility. That will happen this current fiscal year. FY23 we will start investing into expanding our hostel facility so that we are also increasing our capacity accordingly.
Same factory.
Okay. Okay, fine. Thank you. Thanks for that.
Thank you.
Thank you. The next question is from the line of Arvind Kothari from Niveshai. Please go ahead.
So congratulations on a great set of numbers. I was wondering if we have also done a comparison of what has been the price increase by our competitors like Sri Lanka and Sri Lanka, and whether they are facing some issues because of the situation in Sri Lanka in terms of currency and all the things. So are we winning orders with respect to them, or they've also taken price increases, which in a way puts us better off, or are we worse off is one thing, if you could clarify?
I think both in Sri Lanka and Bangladesh. Are they also taking price hikes?
Oh, yeah. So you mean to say that the competitive countries, right?
Yeah.
So see, they are also, in fact, they have impacted severely when compared to us, because we have at least indigenous raw material, but for them they have to rely on either China or India for Bangladesh or Sri Lanka. So they have been definitely severely affected there. So the price increase is going to be the same or more than us for them, and they have to get the price increase. That is the reason why customers are paying increase of 15-16%. It should be for all. Unless, others demand, they would not be giving to us also.
Got it. And so my next question is on, in the budget, there was a lot of duty changes that happened across, the inputs like buttons and I guess accessories for garmenters. Could you clarify what kind of cost benefit we would get in percentage terms of our manufacturing costs?
So in the budget, I guess there was only one small change for the importers, in terms of people who import under duty can get it, through an obligation they can do it. So that's the only thing, but I don't guess that will be in terms of percentage which can be marked. It will be very, very small.
Okay. Got it. And so this new client that we are talking about in the US, and we in a way last quarter, I guess we had 2 clients that got added in the UAE. So in terms of, volume or maybe value terms, if you could clarify what it means for us or for our growth targets that we had talked about in the last one.
See, one customer we have already got, as I told you, out of 2, one we already got, that's from Middle East, which I told you before. And the other one, the order placed, all done. So that's an US customer. First year, there will be a small portion of our business contribution will be there on either side. So real pickup will be from 23, 24 onwards. So easily it will, take about 10 to 20% of our capacity, our sales. That's the plan.
Okay. Thank you so much. Thank you.
Thank you. The next question is from the line of Shikha Mehta from Equity Capital. Please go ahead.
Hello, sir. I just have a couple of questions. What is our current labor strength, and are we currently seeing any shortage of labor, etc.? Since now COVID all has subsided a bit. So can you just say something about it? Am I audible?
Yeah, now okay.
Yeah, so I was asking if what our current labor strength is and if we're seeing any shortage of labor.
Labor strength.
Yeah, that's it. As I mentioned that, it started improving. Definitely still we need to fill the capacity with the new recruits, which already started working in the last about 3-4 months time. So over a period of another about 3 months time, we should be able to fill the existing installed capacity. And slowly we will be doing, as I said, from May onwards, we will be gradually increasing the number of lines for the second shift without adding any additional machines. So it's on in the right track.
Right. And so what's our attrition rate?
Sorry?
Attrition is month-on-month.
Attrition is slightly on the higher side. Now we have already started working on month-on-month about 5%. So we are working on the serious retention strategies, which will also yield the results in the next 2-3 months time, for sure.
All right, sir. So I guess our orders normally take 3 to 4 months to be completed, and our current order book is around 330 crores. So are we saying next quarter we'll be doing around north of 300 crore top line?
Straight away, you don't make it this way. As I told you, it is over, say, 90% of 330 will be for 3 to 4 months time. So it can be split into 4. So you can work on this. This is the order book we have for the coverage of 4 months of 90%, and another 10 months will be for the next few more months. So we cannot give you the correct number based on this number, please.
Right.
But you can guess it.
All right, sir. Thank you so much. So our employee cost also for the quarter has been on the higher side, which is due to the debt petition, etc. So can you give the normal salary paid for the quarter?
So, like, if you are looking at the employee cost based on percentage, yes, the percentage is on the higher side because of our inefficiency. Once the efficiency comes in, we should see the employee cost in terms of percentage coming down.
Okay, so what percentage would we be looking at approximately?
As per the industry, I think the employee cost anywhere between 20 to 21% should be right, and we are working towards it.
All right, sir. So if you could tell us the percentage of raw material increase we've faced for the quarter, and how long will it take us to pass on the prices? We've already spoken about that a bit earlier, but if you could just shed some light on it.
So raw material cost, can you repeat the question
again, please?
Yeah, so how much percentage has the raw material cost gone up by?
So it all depends on the product mix. Like if the basics, if you work on basics, the raw material cost will be on the higher side, and if it is on a fashion front, the raw material cost will be on the lower side. It all depends on the product wise which we work with.
Then,
so
if you could give a broad percentage.
It will be anywhere between 35 to 42% based on the product.
It used to be around 37-38% raw material cost. Now currently in this the current season it is about 40 to 42% because the customers have not been able to increase the price. So again, the thumb rule is normally, as we said from the current orders what we are booking now, customers have increased the upcharge, the cost of increase. So we will be back on track around 37 to 40% will be the raw material cost.
Okay, sir. And sir, could you give us some light? Could you shed some light on the logistics cost? How much is that increased for?
Logistics.
Right. The container cost.
We orders only.
Okay. Okay, sir. I'll come back in the future.
Sure.
Thank you. The next question is from the line of Bharat Seth from Quest Investment. Please go ahead.
Hi, congratulations, Mr. Sundarajan and team on good set of numbers. Sir, hello?
Yeah.
Now, current year, we expect, the base is on somewhere maybe around 750 crore of a garment sales. So, subject to how much we realize up from this order book and the way the order book is expanding as well as we are adding the customer. So, can you give some sense where do we look for FY23 subject to everything is normal and we will be able to ramp up the capacity as well as utilization level and double shift. So how much are we looking for FY23 as well as in the volume term as well as in the because of price value term?
See, as I mentioned in the most of the Concall, we always ask you to just look for about 15 to 20% growth, which is what we are always working towards. And this current year we have the growth is about, we expect the growth to be 25% for this FY22. And next year also it can be between 15 to 25. It's too big range, I know. But same side you can have 15 to 20% growth on the top line. And the bottom line is always, we maintain 18 to 20% EBITDA.
Okay, that's fair, sir. But if we look at, the way price increase we have taken, so will that accelerate some growth percentage?
Which view you are talking about?
So we have taken a price hike of around 15%, correct?
Correct.
So from that scenario,
what exactly is the right increase the customer is going to pay now?
correct. Okay. But if they agree, then the growth rate will be little higher, correct?
That 15% the price will also be an addition, That is what we are trying to say, 20 to 25%.
Okay, fair, sir. And SP UK, how we are seeing the situation now?
Okay, now it's back to normal. It's everything because Europe is open and all the retailers or corporate offices are open. They started meeting the vendors, the people. So it's all back to normal, same as it was in 2019, 18-19. So the whole thing has done. The demands are as usual. Always after the pandemic there is going to be a aggressive demand, and that is what is happening. So only the UK where we have to look at the price increase with regard to the customers, their customers, which will also happen now. So we look the top line, there will not be an issue. We will definitely hopeful of in growth by 20-30%, and the margin will be maintained as it is.
Okay. Last question, on the garment side, the new customer that we have added is more of a basic or a fashion side?
There's a mix of basic and little bit of fashion because they come to us because of our fashion styles only. So it will be about more, say 60% of basic and 40% will be fashion.
Okay. So now you said that in retail we have a aggressive, since it has been transferred to separate 100% subsidiary, and we have aggressive investment plan. So can you give some more color how much investment we want to make till we raise the fund? So it will be from which entity it will be funding?
No, see, in Chairman's note, he said we are raising funds for the growth.
Correct.
Not that we are growing at an aggressive pace. So we are looking to raise funds both if there is a strategical investment coming in or a financial investment or a PE, whatever kind of investment that will accelerate the growth. And so the investment is for the growth.
So definitely we have a plan, we have aggressive plans, and so then if we need to grow, while it was in this company, in SP Apparels, so we did not support them by further funding due to the board decisions. So now this being, Hygraph, as a 100% subsidiary, now they are free to raise the money from anyone else. But the business plan is always, it's very, very positive. Domestic retail is very, very positive now. So, and we are planning of adding, so we have a plan for adding one or two more brands into it. So one will be, now this is Concall is a men's brand, and we have a plan for adding one kids brand, a premium brand. And the third one is going to be a licensee brand of a world famous sports brand, where we will have an apparel and footwear. So the business model and the business numbers are very, very attractive and very, very positive. So with the additional infusion of money, we should be able to take it up for the next 3 years plan.
One more point to be explained here is that there will be no more additional funding from SP Apparels into retail without any aggressive growth that is coming in.
Fair. And sir, on this garment, current our basic and fake fashion mix is how much?
Say it again.
See, in current, 9 months, what is our basics and fashion mix?
Mix, it should be 60% basic and 40% fashion.
Okay. Thank you very much, sir, and all the best.
Thank you. Thank you.
Thank you. The next question is from the line of Neeraj Mansinka from White Pine Investment. Please go ahead.
Yeah, can you hear me? Good morning. Good afternoon. Yeah. Thank you, Mr. Sandrajan. And I have a few questions. One, from which date did you take the price increase?
No, see, prices are quoted based on the orders which we have. See, for example, today I'm getting an order, I go with the today's pricing. So it's not like you don't go back and get the pricing.
It is not a commodity. Our products are.
No, I understood. Okay, so let me rephrase this question. That from has the Q3 seen the full impact of the price increase passed on to customers, or the full impact is yet to come?
Partly it is getting passed on. Maybe orders for like basics and all could have been passed on. For certain orders, it could have not been.
The same case for Q4 also.
Okay, so then Q1 would be the full impact. Is it right?
Yeah. Right.
Okay, got that. The other thing is, how many employees do you have right now, and how many machines?
Currently, we are working with 12,500 employees on roll, and we have 5,100 sewing machines in house, and capacity utilization is close to around 62%.
Okay. So one related question. You had told in the past also that you don't need to add capacity now, considering that you're trying to go for a double shift. Right? So what is do you think that by May you would be able to start scaling up the double shift? And do you see any delays of that increasing the double shifting of the resources?
Yeah, we are looking towards May, where we will start up the double shift process.
Right, and
overnight, but gradually you will start having 3 lines, 4 lines, and 5 lines, and gradually you keep adding.
But is answer clear for your question?
No, actually, some related also. So then why are you, see, your utilization is low, but you still want to go double shift. So can you explain that? Because I thought
there are certain factories which are associated with the hospital, correct? We can have second shift only in hospital factories. So for the local factories, we will continue to fill the existing capacities. At the same time, for hospital factories, there will be more inflow of people. So here automatically we will not stop the inflow. We will add on the night shift lines.
Okay. So is it the availability as an issue? Because see, one thing I'm not able to understand is industry is getting a lot of orders today, but you are still running at 62% utilization, and there's a lot of scope to increase utilization as well as to increase the hospital facility and go for double shift. So then what is stopping you? Is it the availability of labor or some other operational issue which is stopping you to scale up?
See, all of a sudden we cannot simply bring in 1,000, 2,000 people. So it has to happen on a month-on-month basis. So that is what is happening now. So in the next 2-3 months there will be more of inflow, and we have to train them and put them on job. So it takes its own course of time.
Okay. So the last question. So how do you see the employee scale up in number of employees from here in next 2 years? And how do you see the training for them, facilities that you're planning? I just wanted to get your thoughts on that.
Based on the growth rate, we said that 20-25%. The same manner, first we will fill the capacities, existing capacities, and then we'll reach a level where year on year there will be a growth in workforce by about 20-25%. And we have a proper training center, so we take first people, train them up, and then put them after certain period. Once we evaluate and found suitable, then we'll place them in the thing. So this is a routine exercise.
Okay, but can you give some number, like in terms of which you explain us how you are thinking? how many employees you see in 2 years from now? What was
20 to 25%. So you can think now he says 12,500. So naturally there is going to be another 20 to 25%.
Okay, so or almost 40-50% addition in employee in next 2 years.
See, every sewing machine I have to have at least 2.25 people on the roll. So like every operator needs to be there and the helper needs to be there. So for every machine I add, I need to have a 2.25 as a roll. So for example, I add 1,000 machines next year, I have to add another 2,200 people on my roll.
But this doesn't include the double shifting, right?
Now the strength. So if it is a growth of 20%, so naturally you can say another 2,500 will be the growth.
Okay, no, I was trying to more understand from machine versus employee, because your machines, what I thought in the past also you were saying in the Concall that your machines won't increase for some time because we were going to slightly three plus number of employees versus the machine per machine. So
the machine man ratio he mentioned, it is for each machine to 2.25 is the ratio. So you can either way you can work machine versus work.
No, but this is for single shift, right? This is for single shift, but when you go for double shift, your efficiency improves more.
So there again the number of machines will increase. No, even if it's second shift, if we are running 500 machines, we are not talking about installed machines. We are talking about running machines.
Okay. Okay, got it. Yeah, got it. Great. Thank you very much.
Thank you.
Thank you. The next question is from the line of Shivam from JHP Securities. Please go ahead.
Good afternoon, sir. Thanks for the opportunity. Couple of questions. One is on the employee availability, just continuing on what the previous participant asked. So when I go back to my notes of the last quarter con call, you all had stated that two-shift facility will start by, it means you all will start two-shift operations in one factory by September. So has that started?
See, as we mentioned also, because of this Omicron thing, it has disrupted the whole thing because the inflow of workmen from other states have been, the government has stopped them. So now it has resumed. So literally we have lost about 3 to 4 months time. So again now it is resuming. So again I'm telling you, there is one more pandemic, if one more this viral spread comes, even we don't know what will happen. So these are all only the risk factors. So what we planned for September has moved to January again. Now we are planning for May because it's a disruption to resume. It takes about 6 months time until we stabilize. After that there is no big issue. While in the process of stabilizing, this disturbances is really disrupting the plans.
Got it, sir. So, sir, assuming you all have 2 shifts in the next year, over the next year, so what would be the capacity utilization then for the next year that you would be targeting? So it's currently at 62%.
Also around 80% we mentioned. 80 to 90, then probably we will be adding more machines.
Okay. 80 to 90%, and this would be on 5,100 sewing machines.
As sir said, we may be adding a couple of more machines next year also.
Okay, got it. And sir, when I on the GP margin, when I look at the standalone figures, and I think that would give me a better understanding of the garmenting division. Correct me if I'm wrong. So when I look at those numbers on a Q-on-Q basis and on a YOY basis, the GP margin hit has been pretty substantial. So if you could just give some color on how our raw material procurement has been over the last quarter and what led to this hit. If you could give a little more granular understanding, because as far as I know, we keep 3 months of cotton inventory with us, and in a rising environment, one would have been able to pass on the price, right, with the low cost inventory remaining with us, as in our stock. So this kind of a hit would not have come in this particular quarter. So just wanted to understand this part.
So I think you didn't listen to the previous questions which have been come. So we have already explained this, why there is a hit. This is purely because of the product mix. So when I do more of a product which is basic in nature, there will be no value addition in terms of my cost. So when I do more of basics, then my material cost is always on the higher side. And more consumption towards the yarn or the fabric is going to increase the contribution. But in terms of margin, we have guided for 18 to 20% of margin. Don't look at margin separately, EBITDA margin separately and gross margin separately. If my basics is going to be the basic contribution is going to be on the higher side, my personal cost could be on the lower side. So we have to look at it holistically. Hope I am clear.
Yes, got it. And sir, if you could give me the volume for this quarter in the garments division.
Now we have already given that in the presentation, but still 13.6 million pieces exported and 0.4 million on the domestic front. So both put together 14 million pieces.
Sorry sir, I missed that. Thanks. Thank you sir. That's it from me.
Thank you.
Thank you. The next question is from the line of Resham Jain from TSP Investment. Please go ahead.
Yeah, hi. Good afternoon, sir. So my question is on the growth which we are expecting for FY23. Considering that this quarter we have already done around 225 crores, which means we are already going to, if we do this run rate, that itself will give us that 15-20% kind of growth, assuming there is some more price hike which was not available during first half of this year. So are you saying that the run rate in terms of volume will be similar to what we have done in 3Q?
I think volume could be around anywhere between 10 to 15%, and the price hike could be anywhere between 10%. So that is why Chairman has instructed that it will be 25% for FY23.
See, definitely we are planning for...
That is what I am asking, that if I look at the Q3 run rate of garmenting export revenue, the growth doesn't seem to be very high. It means that you are not adding to incremental volumes next year.
Yeah, that's what I'm trying to say is that we are planning for capacity increase by about 20%. And also the price increase will be around 15%, correct. But because it is not for all we will be getting the 15% growth, so we have to work in such a way that combined it will work around 25%. This is what we mentioned to you. So this is only the range we cannot assure you on the numbers now.
Yeah, I understood that part, sir. What I was just saying is that this quarter we have already done 225 crores. That means we are already doing 900 crores kind of run rate. And which means that next year on this run rate, whatever we have done in Q3, it seems that because 1Q and 2Q was anyways much lower for us because of multiple issues. What you are saying is that you will maintain this run rate and some marginal 5-7% growth rate is what I'm coming to. When you say 20%, 25% growth, the growth doesn't seem to be very large. The volume growth obviously doesn't seem to be more than 0%.
So you already done it. So the 225 per quarter we have already achieved. And the Q4, and I mean, if you look at the run rate, the 225 average if you take, this 225 is also not with the existing capacity, also the previous one which was because of the container issues and other things. This has happened. So 225, if we maintain this 225 in for four quarters, it will be easily around 900 crores, easily.
And incremental, that could be 10%.
10% incremental increase.
Okay.
So you can
got it, sir.
Close to 1,000 crores it is coming to.
Okay.
So you are trying to say this incremental growth is not very attractive, you mean to say? Not aggressive.
No, sir, I am not saying that. I am saying that you are already doing that kind of run rate to reach that 20% growth. So the incremental capacity doesn't seem to be coming in. But what you are saying is that you will do 900 crores and then plus 100 odd crores. So you can actually do 1,000 odd crores next year, FY23.
Okay. So I have also said it in the interview CNBC that we will be achieving 1,000 crores in 2023 FY.
Yeah. Got you, sir.
Yeah.
So basically growth will be more towards like 30% rather than 20% what you are saying. Understood.
So you want me to say that you have done all the homework. Why did you try to take it from me?
Okay, sir. So the second question is, we are doing a nice thing by doing debottlenecking, by putting up hostels. But in terms of the real capacity addition, when do you think we need to start putting up newer capacities for incremental growth beyond FY23-24?
See, this itself, with the existing setup, we can easily grow another 40 to 50%. So, which means for another next 2 to 3 years time. So, this itself will, give you the required increase. Plus, we have a plan of another one big factory into 23-24. Maybe one more, 2 big factories we will be planning to put up in 23-24. Depends on how this 1 year post-pandemic, how the things are settling down, depends on that. So definitely there is a plan for 2 big factories that is not ruled out. Where, we will also do some consolidation. It is not that straight away this. There may be a reduction in number of production sites by another 2 or 3 big, small factories, rented factories will close down.
Okay, understood, sir. And so the last question is, given that our capex is quite limited over the next 24 months or so, and the cash generation is quite high, and also retail will not require the money. So how do you plan to deploy the money which you are going to earn over the next 24 months, which seems to be quite large? Your debt is already at 100 crores, which is all at subsidized rate. So all of the cash which you will be generating now seems to be like a free cash flow.
So anything in terms of cash, capital allocation, I think we have already guided for 15% of the EBITDA will be distributed to the shareholders accordingly. And if at all we have cash accumulation, the capital will be used effectively for either to pay off the shareholders, either by way of dividend or a buyback. That may happen once we see good amount of cash accumulation happening.
Okay, sir. Thank you very much, and all the best. Thank you.
Thank you.
Thank you. The next question is from the line of Ridesh Gandhi from Discovery Capital. Please go on.
Hi, sir, and congratulations on your numbers. Just had, sir, just a couple of actually clarificatory questions. So, you indicated that we are running at about a 65% capacity. This is including the capacity on which we can run on, double shifts?
So when we say the capacity, it is not installed capacity. We are, say for example, out of say 5,000 machines, we run 1,000 machines double shift. Then it becomes 6,000 machines. So that is how we look at it, like one shift, one machine installed. So if that is the case, so if it is 60% now, and when we say 80%, that also includes the night shift also.
Understood. Got it. So we've got reasonable headroom to grow on existing capacity as well. And got it. And the guidance which you have given for 15 to 20% growth, is it that volume growth that we are looking at?
As we said that around 60% will be, so in terms of volume, yeah, 60% basic and 40% fashion.
No, I'm saying the 15 I'm thinking the 15 to 20% growth, which we indicated, which we can do next year. That would be on actually volume growth, right? And the pricing would be over and above that. I mean, it's depending on the price of the cotton.
Yeah. In units, yeah.
All right. So then we don't need then effectively any incremental capacity at least till the end of FY24, is it? Because effectively assuming 15 to 20% growth, even for the next 2 years, we still wouldn't be at optimal capacity utilization.
No. Yes, we may not need additional new machines, but as we said that always we may have to have, when we add another about 10-15%, we may have to invest in the new machines to balance the line for each factory. So otherwise there will not be any increase in the number of installed machines other than this 10% because we are using double shift.
Got it. So, but given the overall demand scenario and, what we are hearing from both the offline garmenters, as in the listed and unlisted, is that the demand scenario is extremely strong. So given we have the capacity and given we have the credibility, we have the client base, we have the scale, shouldn't we potentially be attempting for even higher growth? I mean, I know 15 to 20% is a great number, but just wanted to understand, isn't there potential to do even higher?
See,
what is the bottleneck in just taking incremental order?
Yes, it is definitely possible if we get a continuous manpower source. All depends on sourcing the manpower.
Yeah, we have mitigated we have faced the challenge of inflow of the people, workforce. But one thing which I always used to say, the mobilization was the challenge, which we are coming out of this now. But in the big volumes, handling is such a huge mobilization of workmen. Most of them, 90%, 95% are women, all girls. So suddenly, it is not advisable to suddenly take about 1,000, 2,000 people and just put them in the hostel and train them, put them. So this has to happen as a natural course of action. Like gradually per month we can do about 200 to 300 machines. Like this we can increase. At the same time, we have to address on the retention also, because currently we have addressed this inflow, but we are now started working on retention plans also. So what will happen? Say 300 will come, maybe 100 will go. So we cannot just all of a sudden bring in one to manage the whole thing, because the productivity, quality issues, then trading of the material, these are the challenges. So it has to happen only with 20 to 30% of workman growth. This is what we strongly believe in.
Got it. And in terms of just, but is this in your view, because what we're hearing from even some of the larger unlisted, and the Texaco or like Concall, etc., is that people are looking at this as a golden era potentially in garmenting, just because international customers are just looking to increase India's share. Is this something which you are also experiencing and seeing?
Yes, but see, this is a golden era. Of course, the challenge is, the price, which is, now they have accepted. And the second is capacity. See, we simply cannot, just acquire a big manufacturing company and just, manage the whole thing. Rather, we used to grow for 10-15% in the past. Now we are talking about 20 to 25% growth. This itself is the message that, we want to make use of this opportunity. And we do not, maybe I say 20 to 25, maybe if we get to manage 30, 35, we are happy to handle it. That's not an issue. But, when it comes to the official announcement, we only stick to 20 to 25.
Got it. And a last question, if someone had alluded to the utilization of cash on the books, given we've got a really like limited amount of capex, which is coming on stream, at least in the near term, given our leverage levels are reasonably low as well. And given our retail business now, we have committed will no more required capital. What are we going to do with the extra capital? I understand some amount will be received through dividends, but in the event that we don't have the utilization, maybe a good opportunity to utilize it to do a buyback at a reasonable, given the price is also reasonable at the moment.
Yeah, you're right. I think you should have heard the previous call where we have spoken that capital allocation will be strictly looked into, and wherever it is possible and if there is a good accumulation of cash, we will look into a buyback also.
Okay, sir. Thank you. That's all from me.
Thank you.
All the best.
Thank you very much, ladies and gentlemen. Due to time constraint, we take that as the last question for today. I would now like to hand the conference back to the management for their closing comments.
Thank you for the participation in the Concall, and we appreciate the various questions raised by all of you, which shows that how keen you are in this company's growth, and I'm sure that we have been able to answer all your questions to up to your expectations. And please rest assured, as I promised also the last time, we have very aggressive plans. And as somebody mentioned that it's not really a golden era. I think we are back to the normal textile thing. Although there are always some challenges, but now we have, number one, we have learned how to face these challenges. Number two, the whole thing is in our favor. This industry is, in our favor. And the third one is that, the talk of this industry all over the world is the free trade agreements, which are already the dialogues have been started. So we are very, very optimistic about it. So the customers, one of the reasons why customers are, focusing more into India is they also anticipate FTA agreement very soon. So all these things, considering all these things, yes, the garment industry and the textile is very, very, very positive. And it's up to the individual companies how to make use of these opportunities. And we are day and night we are working towards that to see how we can optimize and maximize this opportunity. Please rest assured that we will do our best to see that your expectations are met out. Thank you very much.
Thank you. On behalf of Batliwala and Karani Securities, we conclude today's conference. Thank you all for joining. You may now disconnect your line.